Welcome, everyone. Today, we're diving into the absolute essentials of the stock market. Whether you're looking to start your investment journey or just want to understand how all of it works, this guide covers everything from stocks to bonds to building wealth over time. Before we begin, a quick reminder this is only for educational purposes. Investing involves real risk, so always consult a professional if you're unsure. Now let's talk about why you need to invest. It's because of inflation, the silent wealth killer. If your money is just sitting in a savings account, it's actually losing purchasing power every year as costs for goods and services rise. To maintain the same lifestyle your parents had on $1 million, you might actually need $10 million in the future. This is where the stock market becomes your most powerful ally. So, what exactly is a stock? Simply put, it's a unit of ownership in a company. When you buy a share, you become a shareholder, a part owner. This means you have equity or stake in the company's earnings. As the company performs well, the stock price rises, and the value of your ownership increases. These shares are traded on stock exchanges, which are digital marketplaces where you can buy pieces of global giants like Apple or Tesla instead of household goods. You don't need to be a genius trader to build wealth. You just need to understand compounding. Simply put, you buy quality companies and let them grow over time. Look at the data. If you invested $1,000 in the S&P 500 back in 2015, that single investment would have grown to $3,667 by 2026. That is nearly a four times jump just by being patient and staying invested. Compounding follows an exponential curve. In the first 5 years, growth almost feels small and boring. But this is where most people give up. But look what happens around year 20. The curve turns vertical. By year 25, you can actually quadruple your total wealth just by waiting an additional 5 years. The magic happens at the end, but only if you have the discipline. Some things that derail compound growth are panic selling during market downturns, as investors lock in losses and often miss the recovery. Another thing that derails compound growth is trying to time the market. Even a few missed best days can drastically reduce long term earnings. Starting too late, even delaying a couple years, can mean losing decades of growth. The best time to start was yesterday. The second best time is today. Compound interest means earning returns are not just your original investment, but on growth that money is already made. It's the eighth wonder of the world. Before you trade, you need to know the language. You'll see ticker symbols like MSFT for Microsoft. You'll choose between market orders for immediate buys or limit orders to wait for a specific price. You'll also hear about bull markets, when things are looking up, because when a bull charges, it points its horns upwards. And bear markets, when prices drop 20% or more, because a bear swipes downwards. For many, the best way to start is with ETFs or exchange traded funds. These are like baskets of stocks that let you own hundreds of companies with a single purchase, giving you instant diversification with low fees. To evaluate a stock, look at the PE ratio, which compares the price to earnings of a company to see if the stock is expensive or cheap. The market cap tells you the total value of the company, differentiating giants from small and upcomers. Lastly, volatility measures how wildly the price swings. Tech stocks often have high volatilities, which big price swings, while utilities companies usually have low volatilities, less price swings. If stocks are the engine of your portfolio providing speed, bonds are the brakes in suspension. When you buy a bond, you aren't an owner, you're acting as the company's bank. You exchange high speed potential of stocks for a contractually guaranteed stream of interest payments and the eventual return of your original loan amount. The main reason you should have bonds in your portfolio is because of the predictable income. Fixed rates mean knowing exactly when and how much cash flow arrives. Capital preservation, generally less volatile than stocks. 20% weekly drops are rare. Safety hierarchy. In bankruptcy, bondholders get paid before stockholders, a more secure fallback. Bonds are entirely risk-free. However, there are two main things to watch. First is the interest rate risk. When the general market interest rates go up, the value of an existing bond usually goes down. The second is credit risk. The risk that a company or government you lent to might face financial trouble and be unable to pay you back. Dividends offer a unique sweet spot between stocks and bonds. They provide regular income throughout payouts, but unlike bonds, those payouts can grow over time as the company's profits increase. This provides an inherent hedge against inflation. The dividend yield tells you exactly what percentage you're getting back in cash every year relative to the stock price. The golden rule of investing is don't put all your eggs in one basket. A resilient portfolio balances different types of stocks. You have growth stocks like Amazon that reinvest everything to expand rapidly. Then there are blue chip stocks, which are stable industry leaders. Finally, value stocks are hidden gems, trading below what they're actually worth. Balancing these types of stocks will help protect you against market corrections while still positioning you for stable, high growth. You might hear about hedge funds, private vehicles for wealthy investors using complex strategies. While they sound exclusive, they often come with high fees and lockup periods, where you can't touch your money. The reality is that most hedge funds actually struggle to be a simple, low cost index fund after all those fees are taken out. For most of us, sticking to diversified ETFs are much more of an effective strategy. By learning the language and embracing the power of time, you're already ahead of 90% of the population. Stay patient, stay disciplined, and let the compounding do the work for you. As the Vanguard founder John Bogle said, the people who succeed are the ones who are patient and disciplined. Hope you enjoyed this video and see you again in the next video.